Okay guys, let's value HIMS. I haven't done this one in a little bit. I want to do this one from scratch. We just did Palantir. We couldn't get really close to the current share price, but I'd like to value HIMS just, from a more textbook approach, or my own approach, whatever you want to call it. So I just have the 10 Qs on my other screen here, and I just want to start writing some of the, the data points. So in this tab over here, I'm just going to write price shares outstanding, the market cap, the cash, and the debt, EV, whatever. I mean, they don't have debt, so it's okay. But usually I want to know the enterprise value. Okay, so as of Friday, it was $16.57. Shares outstanding, there's two classes of shares. If you go on their Q2 or annual report, you can see that. So they have the Class A and the Class K, so you can just add them together, 208.7 plus the 8.3. So they got 217 million shares outstanding. This is in 2024 Q2. Let's paste this bad boy down. All right, market cap is, B3 times B4, it's like 3.6 billion. The cash on hand, you're just gonna add, the 100, I'm looking at the for the 130 million, plus the 98 million, plus the other 1 million. This is just all short-term cash, liquid cash, basically they can get really fast. And if you look at their liabilities, they have a little of that lease liability, that's like $1 million, but they don't really have any debt that I care about too much, so I'm gonna just say there's no debt, okay? So the enterprise value is just really, that minus that, so it's like $3.4 billion, so. Okay, so what do I care about here? I just want to first make some data points. I want to write the last quarter one, quarter two for 2023 and 2024. So if you guys open the kind of the quarterly reports, we can start with the most recent filing, and we can just write some basic stuff down. So the revenue, cost of revenue, which is COGS. Let's look at gross profit. Let's talk about that marketing expense, baby. It's high. All right. Operations and support. T&D, tech and development, G&A, general administration, OPEX, operating income, other income, pre-tax income, so I guess they don't pay taxes, but yeah, we should probably include it because they're going to be profitable now. Net income, EPS we care about. I need the shares outstanding. Let's look at revenue growth. It's kind of important. Let's put gross margin first because that's really important too, and then let's put revenue growth at the bottom right. Alright, let's load this bad boy up. I have the Q2 report, so let's start filling in some numbers, right? So the revenue was that... whoa, that is not right. That is too much. That's the full year projection. I was looking at ticker. Okay, so, okay, now I have the quarterly report. So let's say there's so about 360 million. Cost of goods sold, 59 million. This is going to be that minus the cost of goods sold. Okay, marketing expense is going to be about 130 million. Operations and support is 39 million. T&D is 15, 35. So the operating expenses is going to be all of this added together, right? Is that going to be? No. So this is the sum, this, okay, about 220 million. The operating income is going to be the operating income is gonna be, let's see, I don't think we did this right. That OPEX seems kind of low. So that's 200. The marketing expense is it's 145 million. I was looking at 2024 Q1. Okay, so that makes more sense. 145 million, 41 million, 19 million, 41 million. So that's OPEX is that. So this is gonna be the gross profit minus the OPEX. Other income, they had about 2 million. 13 million is going to be the pre-tax income, right? Because it's going to be this plus this, right? You're not going to pay taxes, right? It's basically zero. And then net income is going to be this minus the amount of taxes you pay, right? So the EPS, let's put the shares here, 235. It's going to be this divided by this. Yeah, nice, 6 cents. Okay, let's copy this bad boy over here. I'm just going to start writing it in so we don't have to wait too much. Marketing. I'm just reading it straight from the balance sheet, right? About 2 million pre-tax income is that. They're not paying taxes there either. So net income is how many shares? 208 shares. Still that minus that. So that's still 3 cents. Cool. Okay, and I'm going to fill these out too. Put up the other quarterly report. Q1 278 million, 49. Marketing expense is high once again. This keeps going up. And him's got some crazy marketing expense, right? Nah, they need it though. So it's 34 million. It's all back. Operating income is that. They had 3 million in other income, so that's their pre-tax income. They paid $1 million in tax, right? They're profitable. That makes more sense. Net income 12 million. Okay, so it's about 6 cents there too. How many shares outstanding? 229. Okay, 206 million here. Copy this over. What is 91? Cost of goods sold is 37. About 154. Marketing expense at Q1 is 97 million. Purchases 5 million, 12 million. Okay, it's 30 million. The tax income is that. They paid, what's their other income for Q1? Their other income was 2 million. They didn't really pay taxes because they weren't profitable. Makes sense. Okay. Yep. So they were negative 4 cents EPS, right? So what's the gross margin? I mean, the gross margin is just the gross profit, right? Over the revenue. Wow, that's really good. Really, really good. Revenue growth is going to be this over this minus 1. Same thing here. 45%, 51%. Really good. Hims is a beast. Okay, so we got this, and now I'm going to start rating the other fiscal years. We got to do this unfortunately because I'm trying to see what's going on. I'm trying to get the full story here, right? So I think I need to make some more assumptions later, but I'm going to just start with rating up 2021 to 2024. So, yeah. Let's paste our formulas over so we save some time, by the way. Okay, so 272, 136. Okay, operations and support 48, 22, 114. Except the other income and 4 million other income. They taxes, they got a refund. Very cool. Alright, 187 million shares outstanding. Okay, 2022 they had 205. 2023 we had 209. We're gonna end this year with like 250, so 220 shares outstanding, right? Okay. Gross margin is gonna be this. Yeah, 75%. Okay. So let's put these numbers in for 2022, 2023. 527. Wow, doubled in revenue. What a freaking monster. Marketing expense was 273 million, 77 million, 30 million, about 100 million. All right. Other income is about 3 billion. They pay any taxes? They didn't pay taxes. All right. So what was this year's outstanding? 205. Did that wrong? Okay. If we take a look at this. 57 million. Let's paste all these bad boys down here. That's the marketing expense, 445 million. Okay. What's TMD? 50, G&A 130. OPEX is really high. Operating income, other income, what did they do that year? About 8 million. So negative 11 cents. You can see like you're rapidly getting to close profitability. That's really good. Okay, so I'm gonna need to start doing some bastardization here. So what do I think they can make here? Well, probably like 370 million, and then Q4 they could probably do like 450 million, I think. Right. So what is the revenue? Well, revenue is gonna be these. I gotta add them together. Revenue is going to be these guys added together, right? Okay, so that's the whole revenue. I'm assuming for I'm assuming for those quarters, right? So what is the cost of goods sold? Well, I think I'm gonna have to assume a gross margin to do this, and I'm gonna assume 81%. I think, right? So that's what it's kind of been, 81, 82. So I'm going to assume this year it's 81, and then I'm going to assume it slows down a little bit, because I mean, that's a super high gross margin. I can't think they keep that forever. It's got to slowly dwindle a little bit down, right? So what does that mean? I mean, that means that if we do some fancy maths, their gross profit should be this times your gross margin, right? That's just math, I think. So that means their gross profit is 1.1 billion, and their cost, it's got to be this minus this piece of shit right here. It's 262 million. Okay, that makes sense. What do we think their marketing expense is going to be? Let's say it increases by like 45% from here. I mean, look how rapidly it's going up. It's got to increase really high, but I mean, it's not like it's linear. Let's say it goes up by that. And then this, let's say this goes up by 20%, right? Oof, 1.2. And let's say this goes up by fucking like 25% or some shit. Whoa, what's going on here? 1.25. G&A, what is that? Let's say that goes up by 20% too. Blah, 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 blah. Wow, so we got OPEX like a bill. That is insane. Okay, operating income, what do you think? Other income, we'll just keep it at like 8 million. Other income's pretty negligible, so their pre-tax income is about $115 million. What do we think? What do we think here? So in terms of operating expenses, right? Operating income, other income, that's their pre-tax income. Does this make sense? Yeah, I think this makes sense. Let's assume this is a 20% tax rate. Maybe it went, yeah, I think these assumptions are okay. So we'll assume they pay 20% in taxes. So they will assume that at the end of this year they pay like 24 million in taxes, okay? So that's an EPS of 0.43. I think I'm being a little too aggressive here. I mean, not enough aggressive with either one of these expenses. I could totally see, I mean, that's kind of doubled almost, so maybe we need to go a little higher. And a little more for this one, yeah, maybe 25%. It's just so easy to rack these costs up when the numbers are low, right? And then maybe the marketing expense, 45% is not enough, right? So let's do like 47%. Anyways, you're getting like an EPS of 0.36. I mean, I think this is pretty achievable. I mean, they're improving EPS and free cash flow and all, net income really rapidly. So I think these assumptions aren't too crazy, right? That's just this year, right? Okay. Now, let's put in our revenue growth. Well, these are in the wrong line, but it's okay. So what are we saying for revenue growth? Well, revenue growth is this divided by this minus 1. And then let's make this a percentage. Right, pretty crazy stuff. So what do we think they can do in 2025? What do we think they could do? Let's see. I don't want to be too aggressive with the revenue growth, but maybe let's assume something like, 25% at first. And you might think that's a little crazy, but I mean, they've been increasing it like a lot. So I'm assuming like a quite a bit slowdown from the regular growth. But I also don't want to be like a little too conservative. So let's meet in the middle and say 25%. Say after that 22, after that 18, and we'll say there we're on like 17 or some shit. Right? So these are all percentages. I'm gonna make these percentages. Oh, that's not what we need to do. It's okay. 25%, 22%, 18%, 17%. Okay, so what is this gonna be? That's gonna be this times 1 plus this, right? So we're saying by 2028 we're gonna have like 2.9 billion revenue. Okay. I'm gonna assume their gross margin goes down, right? Super slowly. I mean, they might be able to keep it up, but let's just try to be like a little safer, I think maybe I need to reduce it a little more. 78%, 76%. Oops. And let's say 75%. Okay. Right. So what? Their thing is gonna be that. It's gonna be like that. I mean, let's say from here it's this. I'm just gonna try to amortize it like kind of evenly, even though I think it's gonna be fluctuating. And then at one point, marketing expenses is gonna go down, right? Because you cross-sell products. So I'm gonna amortize this at 10%. I think that's not a terrible assumption, right? Because you might have some peaks and troughs in that. And then what do I want to say for tech and dev? Let's just amortize that after also at like 10%. I mean, 25% is kind of crazy. Can't keep going that high. So let's do 11%. This. Okay, we're gonna say, what is this? Yeah, let's do that 10% too, right? It's gonna be this times 1.1. Let's go. Let's see, G&A. Do the same type of shit here. Times 1.1. And you know, the big thing is this marketing expense, and it's gonna go down. I just don't know when. You know, if you start looking at future years, once this goes down a little bit, because you know growth is gonna slow, and you don't need as much. You don't really need a lot of marketing expense to retain customers. So that's OPEX. Wow, 1.5 billion. That is wild. Bring it in here. Okay, I'm gonna. Why is that? Okay, yeah, let's just say 10, 12, 14, 16. Pretty negligible stuff. Pre-tax income. Yeah, let's just do this. Taxes. I'm gonna assume it's gonna be 20%. Net income is gonna be what? Just that, basically. This, I'm gonna assume, you know, you're buying compounders, you're gonna have some dilution. I don't think it's smart to really buy back shares right now at all. So I'm gonna assume 1.04% increase in shares outstanding because of acquisitions and all that other bullshit per year. I think it's pretty fair. Okay. What does that look like? Okay. Well, they do have the buybacks, right? Yeah, no, I think maybe 4% is a little too much. Maybe like 2%. Let's go to 5%. Just trying to be. They do have those small buybacks. Whoops, that's not right. It's this times 1.025. Whoa. Okay, so I think I am being too light on something here. So if I look, yeah, no, they could do that. I think this is probably going to increase faster. The technology. I mean, there's a lot of technology involved. But if we do this, I think we should. Oops. Yeah. So let's do that. Let's do this 20%. Right? They're obviously going to need to do that. I think all these assumptions are pretty right? So we increase the T&D, the technology goes up by 20%. The general administrative, maybe they go up by 12%. Let's increase that a little bit. I'm trying to be as conservative as possible. Maybe you don't agree with me, but you know what I'm saying? Okay. I mean, marketing expense, I have it first here going up. I have a marketing expense going up like almost 50% this year, and then I have it compounded at 10%. Because it obviously doesn't need to go up 50% every year once you know you already have $500 million. And then I said the gross margin is going to go down a little bit, right? So we're all the way at 76%. I mean, they can't keep. I really don't think they can keep a gross margin of 80%, right? So we're saying our net income is going to be a little over $500 million by start of 2029. They're probably going to have more free cash flow than net income, depending on capex. They don't have a lot of capex, so cash flow from operations minus capex. Probably gonna be like probably gonna be like 600 million in free cash flow. You're gonna have around a 3% shares outstanding increase per year. So if I take a little bit of that out, stock-based compensation this year is like 120 million. If you assume it increases 10% till 2029, you're talking like 200 million in SBC in 2028. So you're talking 400 million of free cash flow net of SBC in 2028. If the company is still growing in the high teens to low 20%, that probably warrants like a multiple of like 25, I'd say. I don't think that's unreasonable at all. Like 23 to 25. I mean, 400 million in cash flow times 25 with limited dilution. Right, so maybe even 30 times earnings, right? 30 times 0.4. Yeah. Yeah, so if you have 400 million in free cash flow, right, and you get like 25 times earnings, you have a company that's worth 400 million times, let's say 20, let's go on the lower end, like 23 times earnings with high teen growth. Maybe even 20 times earnings, right? Let's go 20 times earnings. You have an $8 billion company. If you take $8 billion, right, 8,000, you divide it by the shares outstanding, which is 242 million, say 243 million, you get a price of like $33 at the end of 2028. So 2029 share price is like $33. That's pretty good. I don't see anything in here that's like obviously crazy, right? EPS around $2, a little over $2. You have shares increasing. I didn't have shares going down. I mean, what happens if you do like a net present value, right? So I mean, obviously here you have net income increasing like crazy. So what if you have this times, if you just amortize this by an average of 10%, all the way to here, what happens? Let's add another year. 2037, 2038. Right. So I said, yeah, share price is like $33, but if you say that we have like a discount rate, 8%, terminal value of like what, minus 5%. It's sort of NPV of, what is the NPV going to be? NPV is going to be, well, let's see. NPV is going to be my discount rate. What was that formula? NPV is the discount rate. It's the first parameter. And if we take all these net income bullshit, right? I go back here. Yeah. So I'm going to take all these net incomes. Here's net income. Go all the way to, I really should do it to like 2045, 2046 to get a better estimate. And then you're going to want to add the cash back that they currently have. We don't need to subtract debt because really there's no debt that I care about. So the NPV like that. And then you want to take the shares. So this is going to be the share price discounted backwards. So that is what? It's going to be this thing divided by that. Yeah, that's about $18. But I don't have enough years here. Realistically, you're going to want to do this to perpetuity. Need more columns here. I mean, that's not enough years, I think, for a proper present value calculation. It gets more accurate the more years you have. So if I do this to that, yeah, I mean, if you do this into perpetuity, you can say if I discount it from 2042, I'm getting a share price of about $25. And if I just do some like quick of the hand back math, I'm getting around $33 a share. So what is it right now? It's like 16 bucks a share. I don't know if any of these assumptions are like crazy outlandish. So I mean, I'd say this is a pretty darn good buy. I mean, they just have that compounding company that might increase the shares outstanding a tiny bit, but this looks like a pretty strong buy, I think. Yeah, I mean, I own a position in him, so I follow the business pretty carefully, but I haven't looked at it in a while. So yeah, that's pretty interesting. You know, you're getting near like a $25 to $30 share price, depending on how you discount the cash flows back. So yeah, it's pretty cool.